Welcome to the debate. Our focus today is Axis Bank's latest financial declaration. We're looking at the quarter and half year ended September 30, 2025. That's Q2FY26. And the report, well, it presents a really complex, almost contradictory picture. You've got, on one hand, really quite robust growth and market share expansion, but then on the other, there's this sharp, undeniable contraction in bottom line profitability.
It is certainly a set of results that demands some careful parsing, intellectually speaking. The central question we face is, I think, crucial for anyone assessing the health of this major institution. Does this Q2 performance, does it fundamentally reflect what the leadership is calling an all-weather franchise, showing genuine strategic strength and core resilience? Or does that alarming drop in net profit, coupled with significant increases in provisions and, frankly, muted core revenue growth, does that indicate serious underlying financial pressure, maybe even elevated risk that needs to be, properly addressed?
I'm going to argue that the material confirms this strength. The bank's strategic execution, which is reflected in its asset expansion and those core operational metrics, it demonstrates resilience and, importantly, forward momentum.
And I'll be arguing for the necessity for caution here. I believe the substantial decline in net profit and the almost mandatory nature of those increased provisions, they mask deeper pressures on asset quality and, crucially, profitability sustainability.
Right. So my position, it's really built on execution and momentum. When we look at the gross figures, the bank is clearly gaining traction. Total deposits grew 11% year over year, or YOY, and advances grew 12% YOY. Okay, solid numbers. But the quality of this growth, that's what really matters here. They seem to be succeeding in their strategic focus on these granular, high-growth segments. If you look at the combined small business banking, SBB, small and medium enterprise, SME, and mid-corporate, MC, book, what we might call the high-yield focused business segments, that entire portfolio grew a massive 20% YOY.
Those are impressive growth rates. Yes, I grant you that. But growth at what cost?
Well, the cost is being proactively managed, I'd argue. That SBB, SME, and MC book, it now constitutes 24% of the total loan book. That represents a huge strategic shift over just the last 4 years. And mid-corporate lending alone, that surged 28% YOY. But okay, let's move past the balance sheet for a moment and look at the engine room, the core operating performance. Their core operating profit for the entire half year, H1FY26, stood robustly at 20,010 crores. That marks a 4% YOY increase. And for this specific quarter we're analyzing, Q2FY26, core operating profit grew 3% YOY to nearly 10,000 crores. So, nearly 10,000 crores there.
Hold on. Core operating profit is up 3%, but their net profit is down 26%. I mean, that's a giant gaping chasm between the underlying business operation and the actual bottom line. How do you square that?
That gap, it's explained almost entirely by provisioning prudence. Look at their non-net interest income, non-NII. It's strong, especially fee income, which grew 10% YOY. And critically, 91% of that fee income comes from granular fees, not volatile trading sources. Now to your point on the net profit decline. Yes, 26% drop, but it's primarily due to extremely conservative, almost over-the-top provisioning. Specifically, that one-time standard asset provision of 1,231 crore rupees related to certain discontinued crop loan variants. This provision, it's essentially an extra capital buffer. It will eventually be written back, assuming things go well. It signals prudence, I think, not a fundamental failure in the business model.
I appreciate the optimism, but I find it concerning that you're sort of dismissing a 26% decline in net profit for Q2 and a 16% drop for the half year as merely a matter of, let's say, bookkeeping prudence. I really have to push back hard on that narrative because the weakness, it starts even before provisions enter the picture. Operating profit for the quarter was actually down 3% YOY. Yes, okay, core operating profit was up 3%, but that was achieved despite very sluggish, only 2% YOY growth in net interest income, or NII. And that's their primary source of income from lending, isn't it?
But the 3% growth in core operating profit is the point. They're making up the difference elsewhere.
They're heavily reliant on that fee income, as you mentioned. just to maintain that core operating profit metric. And let's not forget the volatility you claim they were avoiding. Trading income saw a massive 55% decline YOY for the quarter. That further strained overall revenues. Now, regarding the provision itself, the total provisions and contingencies, they ballooned 61% YOY to 3,547 crores. Look, when a bank makes a substantial one-time standard asset provision of over 1,200 crores, it's not purely voluntary conservatism. This action, it followed an RBI advisory post-inspection regarding inherent risks in those specific discontinued loan portfolios. That signals a risk that has either materialized or perhaps been identified externally, forcing the allocation of capital to cover it. To me, that is weakness, not just admirable foresight.
Okay, I understand the alarm bells you're ringing about that headline, net profit number. I get it. But I think we have to look past the surface level, particularly in an environment where, let's face it, regulatory scrutiny is high. We agree the 26% drop in net profit is distorted by the 61% spike in provisions. Fine. But here's the key difference in perspective, I think. That 3% growth in core operating profit, which remember excludes provisions and that trading volatility, it demonstrates the stability of the recurring business model. It shows they are maintaining positive operating jaws. Their cost-to-assets ratio, for instance, declined 14 basis points YOY. That proves they are becoming more efficient at managing their operating expenses relative to their growing size.
I'm sorry, but I just don't buy that the operational machine is running smoothly if the profit before tax, the PBT, still declined 19% year-over-year. The need for that 1,231 crores provision, whether mandated or strongly advised, it confirms a necessity to ring-fence capital against latent risks inherited from older, perhaps riskier lending practices. If the core business were truly performing with this strategic strength you mentioned, it should surely be able to absorb risk costs, which amount to just over 19% of their PBT, without such a dramatic collapse in the bottom line. The operational revenue, yes, boosted by fee income, still only managed to grow 1% year-over-year overall, and that's because of the heavy drag from that 55% reduction in trading income. The margin for error here is clearly razor-thin. The bank seems vulnerable to any unexpected shocks, wouldn't you say?
I would argue that agility is their strength, actually. They successfully replace the volatile, non-recurring revenue lost from trading with more sustainable, granular fee income. So they are actively de-risking the revenue stream. And those efficiency gains I mentioned, they speak for themselves. The question isn't whether they faced headwinds. Of course they did. The question is, did the core banking operations navigate them successfully? And the 3% core operating profit growth, for me, says yes.
Okay, well, let's pivot then to the sustainability of that core lending profitability, because that's a major concern for me. Net interest income, the NII we discussed, it grew only 2% YOY, just 2%. Simultaneously, their net interest margin, or NIM, that crucial metric showing the profitability of their lending spread, stood at 3.73%.
Which you have to admit is still better than many of their peers.
It is, perhaps, but look at the trend. While they saw some relief because the cost of funds decreased significantly, down 30 basis points YOY and 24 basis points sequentially, quarter on quarter, the crucial domestic NIM trend has contracted quite sharply. It's standing at 3.82% in Q2FY26, down significantly from 4.06% just a year ago. So how can they possibly sustain the ambitious growth rates you celebrated earlier, 11% for deposits, 12% for advances, if the profitability generated per unit of asset, the NIM, is consistently trending downwards like this? That creates a structural drag on return on assets, doesn't it? And it requires them to grow assets at an ever-increasing pace just to maintain the same absolute profit figures.
That's an interesting point on margin compression, and it's certainly an industry challenge right now, given the interest rate environments. But I'd frame it more as a strategic trade-off. They're actively optimizing their balance sheet mix. The NIM stability they do manage to maintain, it's led by, well, favorable balance sheet engineering. Things like healthy CASA ratio dynamics around 40% on a month-end basis, and the reduction in the cost of funds suggests the deposit mix is improving. Crucially, their growth is high quality and granular. Advances up 12% YOY, yes, but retail loans specifically grew 6% YOY, which provides stability. And they are using their 10% YOY fee income growth as that counterbalancing force, allowing the core operating profit growth, 4% YOY for the half year, remember, to continue despite these slight margin pressures. They're actively managing for profitability through diversification, not just chasing volume.
Managing for profitability is commendable, naturally. But the underlying pressure on NIM suggests that achieving robust NII growth alongside the desired quality of assets is simply getting harder. It feels like they're running faster just to stand still on core lending income.
Well, that assumes the cost structure remains static, but as I said, it hasn't. The cost-to-assets ratio has declined to 2.38%. That efficiency provides a significant buffer against margin pressure.
Okay, let's move to the last major point then, which is where risk truly manifests: asset quality. We need to really dig into distinguishing between true asset generation risk and perhaps a reliance on technical adjustments to polish the reported numbers.
Look, asset quality is stable, and I'd argue high quality. The net non-performing asset ratio, NNPA, is stable at 0.44%. It actually declined 1 basis point sequentially, quarter over quarter. Furthermore, their aggregated coverage ratio is extremely healthy at 147%, and that includes specific, standard, and additional provisions. We simply cannot ignore the impact of what they term technical impact on the slippages.
And just remind us, what exactly is that technical impact?
Right, so it refers to assets that might technically slip into non-performing asset status, perhaps due to procedural reasons, but where the underlying credit risk is still considered sound, or maybe where a clear recovery mechanism is already in place, often due to changes in how things are categorized for regulatory purposes. When we adjust for this impact, the gross slippages, they drop significantly from about 5,700 crores down to around 4,200 crores. So, this adjusted view, I think, clearly shows improving underlying asset health, particularly in the vital retail segment. If we look specifically at retail, net slippages, when adjusted for recoveries and that technical impact, were just over 2,000 crores, which is actually lower than the roughly 2,160 crores reported back in Q2FY25. So improvement there.
Okay, I see why you highlight the technical adjustment. And yes, they are important for showing portfolio trajectory, perhaps. But my concern is that we are constantly being forced to look past the reported numbers to find comfort. The reported gross non-performing asset ratio, the GNPA, is 1.46%. That is actually slightly higher YOYO. And that's the initial risk signal, isn't it?
But that's exactly why provisioning is so critical and why their high coverage ratio matters.
Exactly. But the sheer weight of risk remains concentrated in that retail segment, which makes up 57% of their advances. Retail alone contributed nearly 2,100 crores rupees to the unadjusted net slippages, even after recoveries from the written-off pool. So this segment, despite only growing 6% YOY, remains the primary source of fresh risk generation. The fact that the bank has to constantly utilize significant technical write-offs and allocate these large regulated provisions like that headline 1,231 crores just to manage the reported ratios, well, it suggests to me that risk creation is high, even if management is perhaps quite adept at containing the public optics of that risk.
But the capability to manage risk quickly and effectively, backed by their robust capital position, a common equity tier 1, or CET1 ratio of 14.43%, that confirms the franchise strength. They have the capital to absorb these necessary adjustments. It demonstrates, I think, their prudent risk culture and their ability to stay ahead of potential asset deterioration.
It confirms they have the capacity to manage the high-risk generation, I agree. But the cost of that capacity is exactly what we started with, the 26% decline in net profit. They are paying a hefty price, it seems, for past lending decisions and the ongoing risk associated with their large, high-growth segments.
So to summarize my perspective, these Q2 FY26 results are really a clear story of successfully executing core growth strategies while at the same time engaging in quite conservative risk management. The bank achieved substantial market share gains, growing deposits by 11% and advances by 12% YOY, and importantly focusing on high-quality, granular segments.
The operational heart of the bank, I believe, is strong, evidenced by that robust core operating profit growth. The sharp reduction in net profit isn't a sign of operational failure, but rather it's a necessary reflection of highly specific conservative provisioning actions, including that massive one-time standard asset provision, which provides, frankly, an unparalleled buffer for future stability.
Well, I remain unconvinced that prudence excuses such a, catastrophic bottom line result. While asset scale is certainly growing, the Q2FY26 results highlight, for me, a troubling decoupling between that scale and genuine bottom line profitability, which is deeply eroded by the necessary cost of risk. The weak 2% NII growth, combined with the necessity of making significant, apparently regulator-influenced provisions, indicates that latent risks are indeed materializing. They are essentially being forced to hold an additional cushion of approximately 44 basis points over their already reported capital adequacy ratio, or CAR. That tells a story in itself.
And perhaps we leave the analysis of the material there, acknowledging that this tension between aggressive core business expansion and stringent, almost overly conservative provisioning is a complex trade-off. And it's one that really defines their financial trajectory in this current environment.
An essential complexity, yes. And one for any astute observer to continuously weigh as things develop.